Hi, this is Brian Dolan with the law firm Pepper Hamilton. Each month, Pepper partner Greg Nowak hosts a webinar for West LegalEdcenter, which focuses on issues that are affecting private funds and their managers. This month, Mr. Nowak is joined by Angel Cohen of Turning Funds and Gil Mendez of Red Ivy Funds, along with special counsel for Pepper, Mark Dabertin, for a discussion of innovative fund structures, foreign exchanges, and U.S. securities laws, issues, and implications. You can download a copy of the PowerPoint slides that the presenters went through by visiting Pepper's Insight Center at www.pepperlaw.com, where this podcast is posted. Thank you.
Good afternoon, everyone. This is Greg Nowak from Pepper Hamilton. I'm a partner in the financial services group at Pepper. We're a full-service law firm with over 450 lawyers and offices across the United States. Today, I'm in my Philadelphia, Pennsylvania office as we dig out from the fourth snowmageddon of 2018. This is our fourth large snowstorm in as many weeks, and that stretched from the Washington area all the way up through Boston. And I don't know where you are today, and maybe it's usual for you to get 8 to 10 to 12 inches of snow, but on the East Coast, that can be a very paralyzing event. But having said that, I am very pleased to present our program today. This is unusual for us, largely because of the snow. Our team is spread out among 4 different locations, so we apologize in advance if there are any technical difficulties, but we will immediately catch up, hopefully, in the event that someone has to drop off or is disconnected. First, I'd like to introduce Angel Cohen. Angel is with Factuary, Inc., and also is a managing director of Turing Funds. Angel, you want to tell us a little bit about yourself?
Yeah, thank you. You guys can hear me okay, right?
Yes, we can.
Angel Cologne, Managing Director of Turing Funds, also advisor to several blockchain companies, been in investment banking over 15 years, have co-founded a couple of platforms such as Bank, BANQ.co on the crowdfunding and Reg A Plus side, do structured products and structured finance, just known as a typical architect of various financial structures. Thank you.
Thank you, Angel. And also joining us are Dabertin Mendez. Gil, tell us a little bit about yourself. You're Chief Investment Officer at Red Ivy Capital, correct?
That is correct, and thanks for the introduction. Yeah, my name is Gil Mendez. I'm the Chief Investment Officer for Red Ivy Capital. We are primarily a long-short global equities hedge fund. We have been in business close to 5 years now. Prior to founding Red Ivy Capital, I was running a proprietary trading firm in New York City consisting of a little bit over 100 traders called SMB Capital. Have been trading my entire career professionally, and now happy to discuss some of the more interesting legal structures that we have found to work a little bit better in this marketplace.
All right, thank you, Gil. And then last but certainly not least is my colleague, Mark Dabertin, Special Counsel in the Financial Services Group here at Pepper Hamilton. Mark, you want to tell us a little bit about yourself?
Sure. So I have about nearly 30 years of overall experience in financial services. I spent 5 years with the U.S. Office of the Comptroller of the Currency and about a little bit over 5 years each with what was then Morgan Stanley Discover, JP Morgan Chase, and Citibank. Along the way, I've had quite a bit of exposure to firms with global activities and some responsibilities for anti-money laundering compliance for those firms.
Okay, thank you, Mark. And without further ado, let's get into our topic today, which is exotic fund structures and their implications, including AML and KYC. So if we go to the second slide, securitization vehicles, one of the primary reasons why investment managers look to the SPV is to solve a structural problem. That structural problem can be caused by jurisdictional limitations on who can sell, who can be approached, how they can be approached. It could also be the result of a tax issue. So, for example, we're all very familiar with using offshore corporate feeder funds as a means to provide a blocker for adverse tax consequences for certain institutional investors like pension plans or endowment accounts that want to invest in U.S. private funds where there is leverage inside the private fund. So these structures are long established and are respected by the various regulators. There has not been a serious challenge to a blocker company in years, provided, of course, corporate formalities are followed and the investors are fully apprised of the risks that they incur, none of the least of which is they're working or investing through a foreign organization. More recently, we've seen the rise of wholly owned controlled foreign corporations for mutual funds to hold commodity futures contracts. So why do they have to do that? Because the Internal Revenue Code limits the amount of non-securities type assets that a mutual fund can hold and still qualify for pass-through treatment for federal tax purposes under Subchapter M. Through the miracle of holding futures contracts in an offshore corporation, that means that any income that is paid out of the corporation is in the form of a dividend. So by moving your contracts abroad, the mutual fund solves two problems. One, it is now holding a security, namely the stock of the offshore corporation. And two, the income it receives is a dividend, provided that it's a distribution out of the earnings and profits of the controlled foreign corporation. So again, this is a traditional structure that has been around for decades, and it is well respected in the industry. Now, there was some controversy recently because of a deeming rule under the Internal Revenue Code. The code used to allow an investment owner to deem income earned by a controlled foreign corporation to have been distributed to the U.S. investor, avoiding the need to actually pay a dividend. Well, in a series of rulings, the IRS came out and said, no, if you're going to use the controlled foreign corporation structure, then in order for you actually to receive a dividend that is good income in the hands of the domestic registered investment company, it is necessary for the controlled foreign corporation subsidiary to actually pay the dividend. And so that means cash must move, and then it gets reinvested back into the company. Somewhat of a cumbersome procedure, but after some congressional inquiry and challenge, is about the only way that these structures can work. But look what you've accomplished. You've turned, it's the proverbial Rumpelstiltskin, right? I've just turned what would be bad income and bad assets into good income and good assets through the miracle of an offshore structure. And why do you want to use an offshore corporation? Simply because you don't want to pay tax at the entity level inside of the CFC. And most offshore entities are formed in countries that do not impose corporate-level taxes for this type of structure. So you have a Cayman or BVI or Bermudan corporation that holds these assets. These structures were also very common in so-called life settlement trusts several years ago. Viaticals were generally challenged because of a failure of a life in being by state regulators and the insurance companies who saw the value of their businesses being dissipated. Happy to talk about that further, but that's a little bit beyond the scope of this conversation today. But the benefit of the life settlement trust is that properly structured, it turns these life settlement payments from insurance proceeds, which is not good income, into dividends, again, that are payable to an entity that can only invest in securities or that can only hold or receive, rather, dividends or interest. And then more recently, in the marketplace lending space and others, there's the creation of payment-dependent notes. Payment-dependent notes can exist as a good asset for certain types of structures. However, you have to worry about trade or business issues, again, a tax concept, and you also want to make sure that you have bankruptcy remoteness with respect to the creation of the payment-dependent notes. But the reason or what the payment-dependent note is trying to solve, of course, is the problem of, am I issuing an interest out of or on the balance sheet of the company, or am I simply providing an investor with a return with respect to a specific asset? Payment-dependent notes are one manifestation of that. A more recent manifestation is the coin phenomena, where issuers of coins have been effectively using the coins to strip out specific revenue flows out of a company and provide potential investors, of course this is if it's a security coin, potential investors with the opportunity to share just in those revenues. Another way that oftentimes is created is through swaps agreements. Swaps with a subordination in a fund structure using an account control agreement would effectively allow you to gear the portfolio. When you use the subordination, of course, it avoids the gearing, but the point is the swap does not necessarily result in an actual investment in the fund, but rather it's a pari-mutuel bet between the two swap counterparties. And as we know, swaps do have preference under the bankruptcy code, so you need to be very careful if you use a swap structure that you haven't inadvertently provided one group of creditors or investors with an advantage over the others. So these are just some examples of securitization vehicles that we have seen recently over the last 15 years, if you will, and all of them are designed to meet a specific purpose. Usually it is a character issue. You know, I need security as opposed to a commodity, or I need a commodity versus a security, or it is an income character issue for tax purposes, or I am trying to avoid U.S. trade or business status for tax purposes. More recently, what we've seen, however, is that there is a need for assets that meet a certain qualification so that they can be held in certain types of accounts. So, for example, anyone who has tried to put a private fund into his IRA knows that you have to jump through a series of hoops, have to have a special custodian. Why? Because most IRA custodians are unwilling to hold private assets unless there is a third-party custodian or a CUSIP number or something that gives them the comfort that this asset has been vetted by a third party or a governmental authority. Which takes us to the ISIN structure. And so I'm going to turn to Gil. Gil, you brought this to my attention a couple months ago, and I found it extraordinarily intriguing. So tell us, what's the problem that you were trying to solve with the structure, and then walk us through. How does the ISIN structure work?
Fair enough. So, being a startup hedge fund, even though I had a strategy with a proven result of longer than 10 years, I didn't necessarily have a record under the hedge fund structure. So as for any, starting hedge fund, then the main challenge is always raising assets. And in raising assets, you run into two primary, challenges. One is not having a proper track record, and then two, having just the right legal structure for clients to feel comfortable sending them money and knowing that that their money is going to be safe and that there's proper providers behind it. Throughout my first 2 years of running the fund, I went through the process of creating a limited partnership, which is the typical structure that most hedge funds use, and realized that I was getting to the point of getting my potential customers that wanted to invest, and a lot of them got held up at the point where you have to send them the PPM and you send them the subscription agreement, and it creates just such an amount of work for them. Because these documents, as you guys are aware, are 50-page plus, and it tends to take a good month before I can get any of those customers to come in, and there's legal cost involved with them reviewing the paperwork, and essentially I was losing a lot of potential customers just because of the of all the added work that the customer needed to take on in order for them to just make a small investment. So one of the structures that I contemplated, I looked into was, with the wide improvement in the marketplace and legal structures, somebody suggested to me taking a look at an underlying ETF structure. So I found a provider actually out of here in the U.S. that essentially what they've done is create an ETF wrapper structure, meaning it is a publicly traded security. that currently trades in Europe. And essentially what it does now is it allows any customer that has a brokerage account already that is able to trade a European security. Essentially, as long as the customer has a brokerage account, they're able to essentially buy into my fund via this ISIN structure. And what it really allows me to do is then cut back a lot on the hesitation from a client on wanting to invest. And so there's a lot of nice things about the structure. Primarily, they are, one, it is a publicly traded security. And so, it gives people peace of mind that at least they're sending the money somewhere where it's already been vetted at the exchange level as well. Two, we do use very high-end providers, at least as on the auditor side, and the people that do the fund administration. And the main third thing is that we are able to create essentially an investment portfolio guidelines that fit my criteria for investing. And essentially what I've been able to do is get clients to buy the shares, and I get that money into my Prime account, and then I'm able to deploy it very easily. And lastly, one of the main advantages is the clients can see, how the fund is performing based on the brokerage account. So there's kind of remove a lot of the hardships, if you will, of being involved with a limited partnership and a fund administrator and having to receive NAVs on a monthly basis. The providers that I use can do daily NAVs. They tend to get a little bit more pricey. For their purposes on my hedge fund, we use a monthly NAV, but at least the customer feels peace of mind that, they are just like holding another security. And part of, one of our value adds is that we have the ability for our customers to pull liquidity anytime they want. So there's no lockups. There's no fees to exit the portfolio or to divest from the ISIN. And that, gives a lot of my prospective clients that want to test out the strategy just peace of mind knowing that they can invest a minimum amount, see what the results are like, and then if they change their mind or they want to add money to it, they can do so very quickly and painful, without any pain. But that's just, in a nutshell what the structure is.
All right, so Gil, let's deconstruct some of that a little bit. Again, looking at slide number 3, there is a offshore entity, and in this case, it's an Irish trust, right?
That is correct, yes.
And this Irish trust has series, and you are managing a given series of that portfolio, or is that series investing in your hedge fund?
Good question. So the way that they have it set up is they do have just a general trust for all the investment managers. And so what I do is I essentially receive power attorney to manage the assets of that series that is assigned to me as a portfolio manager.
Okay. And then investors are they're not getting, so you have two pools that you manage, your hedge fund as well as the pool of assets in the offshore portfolio.
Correct. I have actually made an effort within the last 2 years. I shut down the limited partnership. It was a lot more expensive to run. It was very cumbersome. And I asked my clients to essentially buy into the fund via this ISIN. And I've done the same with some of my separately managed accounts of brokers over here within the U.S. rather than me parking positions into each brokerage. It's become a lot more costly effective to ask the clients to just participate in my fund just by buying this ISIN structure. And so it's made my life operationally a lot easier to just essentially manage one account that is just a pool of all of my investors' assets.
And that actually, from the point of view of compliance and complexity, it is a lot easier to manage one pool of assets as opposed to having multiple accounts, especially if you want to rebalance the portfolios and if you need to, try to manage toward a specific benchmark for each set of investments. So this is a simplifying device for you, and it also gives your investors the ability to invest through qualified accounts, correct?
Correct. And one of the major advantages that I found, at least from a regulatory point of view, is that it removes a lot of the KYC and AML that typically I used to have to deal with the LP, that we have to be very stringent about where the funds were coming from and legitimacy of the funds. Now we're essentially passing on a little bit of that compliance risk to the broker, because the money, in order for a client to invest, they need to have a proper brokerage account. And, obviously these banks have to follow much stricter rules when it comes to onboarding any type of client as far as AML, KYC. And so, as soon as the client has that money available at the brokerage level, at least we know that from their point of view, the bank or the broker has already done a certain level of AML, KYC, and it makes my job a lot easier from the compliance point of view to make sure that, I don't have to follow and spend as much time and effort doing the AML, KYC, because I can just refer to the AML from the brokerage level.
Well, before we get to AML, I just want to make sure I'm understanding here. So when I'm looking at slide 4, when the assets are delivered with the arranger and their own broker, right, they're delivered to the custodian, and they receive shares in a fund, correct? So it's not as if it's a separately managed account. So this is an offshore fund that is in a tax-favored jurisdiction where an investor is able, because it has an identifier number, is able to hold it directly in their brokerage account at one of the large wirehouses?
Correct. So it's not a separately managed account structure. I just want to be clear about what. So think of it this way. I want to be a customer for Red Ivy. So I call my broker at Morgan Stanley and I tell them to buy, $1 million worth of shares of the Red Ivy fund. What happens is that the broker then coordinates with the arranger, and essentially they do a delivery versus payment transaction whereby my $1 million goes into Euroclear, Euronext. Once it settles, then as far as I'm concerned, I'm receiving shares of the ISIN of the fund back in my Morgan Stanley account. So I see that I'm holding a net position of $1 million. And then that $1 million goes into essentially the bank account or the prime account on behalf of the fund. And I'm able now as Red Ivy to deploy that capital from that point forward.
So an ISIN, again, for those of you who may not be familiar, is a number that's issued by the International Securities Identification Number. It's the National Numbering Agency. And it allows that instrument, it's an indication that instrument is traded, correct?
That is correct, yes. It is a unique number that is assigned to the legal structure itself. And so investors here are getting a commingled return in an investment strategy that they can hold in one of their tax-favored accounts at a wirehouse brokerage firm. And do they get specific documentation, a PPM, and other things that give them do they get periodic reports? How does the investment structure work? Yeah, great question. So, yes, the typical process for onboarding a client is just like with any other LP. There is a PPM that is sent to the prospective client. We want to make sure that they are accredited investors here in the U.S. Or qualified investors in Europe. Once they review it and they decide that they want to participate, they just send the signature page, and then we put them in touch with, the brokers, essentially coordinate the transaction with the arranger for the fund. The client does receive a NAV on a monthly basis. It's typically 3 to 4 business days after the end of the month. One of the other nice things about it is for at least, family offices and institutional accounts that they have their own Bloomberg, the ISIN NAV gets reported on Bloomberg. And so, again, rather than receiving an email with, a statement, you could also just kind of keep track of the performance of the fund as it is published in Bloomberg.
So the fund performance is published periodically on Bloomberg, and therefore an investor. What about trading? What about liquidity?
So what's interesting about our investment process is that I come from a world of being somewhat capital restrained. And so all of our strategies are deployed essentially intraday. We keep about 70% worth of cash every night in our portfolio. So we're only invested a small part of it from a day-to-day basis. Most of our alpha is generated from consistently trading intraday. And so because of that excess of cash, we're able to provide our investors daily liquidity if they need it to. Just to give you an example, one of my largest customers is the treasury for a company, and they, for example, have, rather than keeping $1 million for 25 days in the bank, just earning, 0.5% annualized, they're comfortable taking a little bit of risk with our strategy, and they're able to essentially buy $1 million worth of exposure on the first day of the month and then cash it out on the 25th when they do have a need again for the money for the next 5 or 6 days. And so, we've created a lot of value add from that point of view to allow, customers from any kind of point of view to be able to come in and come out when they please without, charging them any type of fee for exiting the fund.
So, Angel, you've been in the investment management industry for a number of years now, and you work in structuring transactions for private and public companies, specializing in distressed asset investing. From your point of view, what's the advantage of the ISIN? How does this help investors? How does it help managers?
As far as the clients are involved, there is a ongoing cost of 50 basis points per year for the fund administration, and that is a little bit lower than your typical, tier one fund administrator here in the U.S., where they typically range between, 65 to 80 basis points per year.
So 65 basis points a year, you said?
Yeah, that's the typical fee that a large tier one fund administrator will charge in the U.S. Our fund administrator for this fund structure, they charge 50 basis points, and it tends to go as low as 35 basis points depending on the assets under management under that structure.
Guys, I'm back. Sorry about that.
Hey, Angel, thank you for joining us back. And I did send a message to Thomson Reuters to make sure that they reestablish the line. If it turns out that we do get disconnected in the next 2 minutes, everybody please just dial back in. I do apologize for that. But again, going back to you, Angel, give us some market perspective here. What do we gain by this structure? What do investors gain? And why should they be excited about this versus, investing in a traditional mutual fund?
So with your traditional mutual fund, as Gil was mentioning before, you get a subscription agreement, you go through the AML KYC process, you're incurring legal costs, and what ends up happening is you're kind of pretty much getting a monthly statement, and you're hoping and praying that whatever that statement is correct, it's been verified, and you're not into some things that have happened in the past that we've seen in the hedge fund world. Here you have a listed entity that goes onto your brokerage statement, and now through your broker you can now purchase this hedge fund without going through kind of all the headaches that you were going through before in looking to get into a hedge fund. At the same time, you're receiving your monthly NAV, so you know what the fund is worth, and you have liquidity. Now, back to your statement, Greg, about, pretty much private assets and all these other stuff and looking for a custodian to do that, this product is designed also to go into IRA accounts, self-directed IRA accounts. So it kind of giving you that bridge to get into a product using those types of vehicles.
So what about safety? People understand the U.S. legal system, how it works, what their risks and liabilities are. What do we gain or what do we lose by going offshore to one of these structures as opposed to, again, a traditional structure subject to the U.S. jurisdictions? Have any of these been tested to your knowledge? Gil?
I can answer that. I think that's a great question. Obviously, once you get involved with an offshore vehicle, in this case, it's an Irish trust, they are essentially looking after, the client and making sure that the investment manager is following the guidelines as it was established in the investment portfolio guidelines, right? Obviously, if there was ever an issue, you have, as an investor, you're essentially covered two ways. One, from the side of the trust and the trustee, and then two, at the exchange level, because it is a publicly traded company, so now you have, almost like a much bigger fighter, if you will, looking after the benefit of the client because you are involving a full structure under a publicly traded exchange. Obviously, the one thing that you do lose from, coming into this kind of structure relative to an LP is not having, legal rules, SEC coverage, if you will, at the U.S. level where you can go to your nearest, courthouse and deal with it. But, again, I guess for the better part of most of my clients that are U.S., they do love just the ability of the fact that, they don't have to go through a serious amount of paperwork and as far as onboarding it and dealing with a lockup. And it's, it's just like buying any other security for them, which, brings me to another very interesting point about the structure, which, we'll circle back around the issue of security. Some of my customers now that we are creating a cryptocurrency fund using this infrastructure, a lot of the institutional and, family offices that currently do not have the ability to invest in a cryptocurrency product directly because it's likely not within the investment guidelines. They're now able to do it this way because as far as the regulators and the checkboxes that they're following, they're essentially buying a European security. So they're not necessarily, they're not violating their own investment guidelines. And so I think, this is one of those new structures that is becoming fairly popular here in the U.S. And once you start to get the large family offices and institutions to get behind it, I think it gives it another level of, credibility and assurances that, it is here to stay.
Now, from the point of view of the U.S. legal system, if you have a foreign fund that is publicly traded abroad, in order for it to be offered in the U.S., you would have to register that fund under the 40 Act. And the number of foreign investment companies that have actually been successful in getting registered in the U.S. as registered investment companies, you could count on one hand. So that means that you have to fit this under Regulation S. And Regulation S says you can have a foreign-directed public offering as long as your offering in the United States is not a general solicitation. Because you could do a private placement in the U.S. in the same way that you could do a pipe into a company that has publicly traded securities, and you do a private investment in a public entity. So you can do a Reg D of this fund in the U.S., but it would have to be not pursuant to a general solicitation, because that would eliminate your ability to rely on Regulation S. And to the extent that you have U.S. brokers or U.S. managers managing it, normally that would be a sufficient hook for a U.S. regulator or a state regulator to get redress in a U.S. court, because you would get subject matter and personal jurisdiction over the investment manager or the broker. So there are redress opportunities available. We talked, and Angel mentioned a couple times, the KYC and AML requirements, and I'd like to, if we could, turn to slide number 6, and AML, and ask my colleague, Mark Dabertin, to give us a quick primer on who is subject to AML under U.S. law. I recall a few years ago that FinCEN and Treasury had suggested that, or had proposed rather, through an actual regulatory process, that U.S. investment advisors were going to be subject to an AML procedure. But that never went anywhere, did it?
No, it's still pending, but that does not mean that it won't. Based on what I've read, I would say that it's still a possibility, even though a few years have gone by. And the reason I say that is that there's a very significant global emphasis on AML, and including in the U.S. For example, there's a FinCEN rule regarding the identification of beneficial owners that will become effective May 11th of this year. It actually, the rule was promulgated a couple of years ago with a delayed effective date, and there's just been this really significant, and that same rulemaking, by the way, also requires an enhanced focus on customer due diligence. And so I think with the overall environment globally with respect to AML, I would not assume that rule is necessarily a dead letter. And so what is the rule, and why did it come about, and where are we at? So going back to what Greg first mentioned, so banks, mutual funds, security broker-dealers, insurance companies are all required to have formal AML programs. Pursuant to those programs, formal means they have to have somebody who's in charge of that program. The program has to reasonably protect against both money laundering and the risk of terrorist financing. A covered entity has to file reports of suspicious activities, and they have to be in a position to know whether something suspicious is occurring, which means they have to have certain information. They have to do monitoring in order to know, again, whether something is suspicious. They have certain record-keeping requirements for cash transaction reports, something called travel rule. If a person is wiring money in excess of $3,000, you have to record certain information on that person and provide that and make that information available to the financial institution that's receiving the funds. So bottom line is there are certain rules that apply. So interestingly enough, if you're a mutual fund and you're required as such to register under the Investment Company Act as a mutual fund, well, now you register with the SEC. As I mentioned, you're a covered entity. But if you're an investment advisor, which is a person that's registered or required to register under the Investment Advisor Act, not Investment Company, Investment Advisors Act of 1940, and those persons are folks who offer investment services and may sponsor or provide advisory services to mutual funds, but they're not the fund itself. They're advising clients on purchase, sale of, not just mutual funds, but other products or services offered by insurance companies, broker-dealers. Well, those folks today, as Greg mentioned, they're not required to have a formal AML program. I will say, mention one caveat, even though if you're an investment advisor and you're not required to have an AML program, it doesn't mean that you won't necessarily be touched by AML, because when it comes to understanding who the beneficial owners are, financial institutions turn to introducers, parties that introduce clients to the institution for the information that they're required to collect and maintain. So you could get sort of back-ended into AML requirements if you're serving as an introducer, introducing clients to financial institutions.
Hold on a second.
Go ahead, please. Yes. Okay.
So let's just summarize. A U.S. registered investment advisor is not a primary reporter under the Bank Secrecy Act or AML. However, before they can manage money, it has to be in a bank account or in a brokerage custody account or some other account, and that money will have gone through that process, right? So it will have gone through the brokers or the bank's AML process before it even gets to the account. So in many respects, that's why I believe there has been a delay with respect to money managers under the simple theory that while they have legal custody, they really don't have physical custody of the assets. They don't touch it. So how could they, have that responsibility? By the same token, if the manager is managing a fund, and that fund's assets are held by a qualified custodian, the assets going into the fund still would have gone through a AML KYC review, will it have not?
Yes, and it kind of ties things together. So when those funds go through that KYC AML review, the institution that is covered is required to have certain information on beneficial owners, on the persons for whom those transactions are being executed, and they're going to turn to the party that's introducing the institution to those persons. And so the introducer of the transaction to the bank or other financial institution would have to have available certain information that the institution that's covered requires. That's all I was saying there.
Now, and just a quick aside, if a investment manager comes across activity that it believes is suspicious, is it required to file a suspicious activity report, a so-called SAR?
No, and the problem with that is that, so there's a safe harbor under the U.S. Bank Secrecy Act for financial institutions that file suspicious activity reports, including if a financial institution files a report on a voluntary basis. The problem is that the safe harbor and requirement itself only attach to financial institutions. As things stand today, as you aptly pointed out early on, an investment advisor is not a financial institution. This amendment would make them considered a financial institution, but so long as they're not, you wouldn't want to file or attempt to file a suspicious activity report, because if the person who you filed against got wind of it and they believed that report were false, you could be subject to a defamation lawsuit, whereas a covered financial institution would not be. By statute, they have a safe harbor. A non-financial institution does not.
Right, and remember, the whole point of the SAR program is for FinCEN to get as many data points as possible with respect to activity so that they can use their data crunching algorithms to track trends and also figure out, what's happening with respect to the movement of capital. Obviously, this is all designed to prevent the financing of terrorism and other nefarious plots against the state. So I do think that, it works. But again, asset managers and funds beware, if you're not a primary reporter under the Bank Secrecy Act, filing an SAR, you do at your own peril because you don't have the safe harbor protection. And that is the correct answer at the present time, right, Mark?
Yes, it is. You would not have that safe harbor because you're not a financial institution.
All right, so keeping in mind the structures that we were just talking about, let's turn to slide 7. And just go through some of these investments. A mutual fund is considered a financial institution. Is that correct?
That is correct. They're a financial institution, and because they're an investment company, it's defined under Investment Company Act, and they're required to register with the SEC as such, and therefore they fit within the definition of a financial institution.
Now, just from a policy point of view, how is it possible that a registered mutual fund could, be used to launder money? I mean, it seems kind of odd because most mutual fund transfer agents will only redeem an asset or money back to the account from which it came, right?
Yes. Go ahead.
So, the idea that, you're somehow transmitting it from one person to another is just not there. I guess if the money goes into a mutual fund and then immediately comes out, it theoretically could change the character of the money, but obviously the regulators believe that there is a risk there, which is why open-end mutual funds are listed as financial institutions. Investment advisors, however, are not, correct?
That is correct. They are not. And one of the differences, between the two is in the one case, the entity does handle money, and in the other, they do not, right? They're just providing advisory services, administrative services, but they're advising clients, but they're not actually dealing with the money. And one thing to consider with AML requirements, by the way, is that they also look inward to the organization itself. If there's any sort of suspicion of money laundering, unlawful activity within the organization, you're a covered financial institution, you have to file a SAR if that suspicion involves any amount of money. And that could be one reason why the funds are covered, even though what you're saying is the external-looking money laundering risk may not be so high. The money laundering requirements, again, also look inward. So I'll stop there.
Yeah. All right. So let's look at, slide 8 and the new U.S. AML requirements for 2018. Effective May 11, federally regulated banks and credit unions, mutual funds, brokers or dealers, futures commission merchants, introducing brokers will be required to enhance their account opening due diligence. So what exactly are they looking for, and what should these entities be doing between now and May 11?
Yeah, so hopefully by now they would have prepared quite a bit, since the rule has been pending for a long time and it's just becoming effective now. But one of the big things you have to do is if your customer is a legal entity, which could be a corporation, limited liability company, or some other entity that was created by filing a public document, you now have to identify all beneficial owners that have a 25% ownership or control interest, as well as key officers and directors of those entities. And it's a pretty significant requirement, because you think about it, now you have a whole pool of customers for whom you have to perform customer identification procedures sufficient to identify and verify both the entities and the individuals. One thing I'll mention on this is that the U.S. was actually criticized by the FATF, Financial Action Task Force on Money Laundering, a couple of years ago as being behind the rest of the world on beneficial owner identification and verification. So this is a focus that's happening globally, not just within the U.S. And as I've said, it ramps up the responsibilities of folks who act, for example, as introducers, to have the kind of information available to assist those institutions in satisfying their new burden to know beneficial owners.
So focusing on the products that we were talking about earlier on, Gil, the ISIN product that we have been mentioning is listed on a European exchange, correct?
That is correct, yes.
And which exchange is that?
It trades on two exchanges. It trades on Paris for Euronext, and then on Vienna for Euroclear. So
do you know, and obviously this is very technical, so I wouldn't hold you to it if you didn't know, but I'm assuming that the French authorities enforce the AML directives, the European Union directives, with respect to the Parisian listing and
go ahead. Sorry.
No, I was just going to say the Austrian for the Euroclear listing.
Correct. So, yeah, the actual process to get the security listed, it's fairly stringent. I mean, it probably takes a good part of 4 to 5 weeks to actually get the trust to be listed and receive an ISIN, essentially because it is one, there's a common party, which is the trust and the trustee. There's already a relationship that makes life easier. Obviously, from the arranger point of view, who is the person coordinating the transactions via, Euroclear, Euronext, they obviously have to have, they follow very stringent rules when it comes to KYC, AML, and, they're fairly separate from what the bank, the custodian bank and also the customer broker, the brokerage account or whatever they have their money. And so there's a whole other element of multiple checks, making sure that the money that is coming in is satisfying, the regulators.
Okay. So have you seen, or is this completely seamless? Have you seen any hiccups, issues, difficulties in administering this program? I'm assuming not. I'm assuming that all happens as a matter of course behind the scenes, and you don't even get the money if it doesn't get through the clearances and the procedures, right?
Yeah, good question. So far we haven't had any issues of actually receiving money from a broker. I mean, once the broker has a Euroclear, Euronext ID for clearing a DVP transaction, it's pretty straightforward. The biggest challenge that we see currently is actually getting the ISIN listed at the different brokerages because, the broker itself, so for example, if you go to your Fidelity account or if you go to your Schwab or E-Trade and you try and find our ISIN, it's not going to be seen because it has to go through, even though it's a publicly traded security, it trades over the counter. And so it needs a special type of, compliance check and checking on the back end of the broker who will be sending the money over. And so, from that point of view, there's a little bit of, a hiccup. We're currently listed in the Morgan Stanley platform and the UBS platform and the Merrill Lynch platform in the U.S. And outside of the U.S., we have a very strong relationship with Pershing, who is kind of the major party there in terms of, being a custodian for assets and brokers. But as far as, the actual transaction and being hiccups when it comes to getting the money, that there really haven't been any issues, at least at the fund level.
Okay, so I want to shift gears a little bit and go back to AML and focus, if we could, on one asset class in particular, namely cryptocurrencies, in particular Bitcoin. And I did want to focus a little bit, Mark, on what's happening in Cayman, Bermuda, and other entities with respect to their AML requirements and how that may impact the cryptocurrency market. Mark, what's happening?
Okay, so a couple things I'll say about that. So first of all, AML requirements, although in many respects they're substantially similar globally, they're not identical because, you have the U.S., you have the EU, where you've got some consistency, right, between the member nations, and then generally you've got sort of very, very closely similar rules globally, but again, they're not identical. So something like, virtual currency in the EU, Fourth Anti-Money Laundering Directive takes the position that virtual currency is a form of money. In the U.S., it's more complicated. So when you're talking about where it may or may not be, depending on the facts, so whether it's a medium exchange that's, used like money, et cetera, et cetera. So in any sovereign nation that you're talking about, whether it be Bermuda, Caymans, elsewhere, you first have to start with looking at that particular nation's requirements to see how they treat a virtual currency, and do they treat it in an identical way to money, or is it more nuanced? The next thing I'll say about, I have a little bit of familiarity with Bermuda and Caymans, and I did assist an institution with some anti-money laundering matters a couple of years ago, and spent some time sorting through their laws. I can tell you that in Caymans and Bermuda both, if in fact what you're dealing with is covered by their anti-money laundering requirements, their requirements they're very robust. They tend to be more, I would say, document-based than U.S. requirements, and there's some peculiarities. For example, in Bermuda, there's a focus on things like verifiers, which we don't encounter with the U.S., and that's where you can accept documents, but they have to be verified by somebody who would, not like a notary who just verifies the signature, but somebody who would have knowledge of the underlying facts. Another nuance I'll give you for Caymans, I know that in Caymans, a mutual fund, just like in the U.S., is covered as a financial institution, but so is a person who administers a mutual fund and under separate requirements. So again, you have to start out looking at those the foreign jurisdictions, laws, and regulations at the outset. What do they cover? Who do they apply to, which is a really big deal? And then, never assume that they're the same as the U.S. You've got different expectations for another one. I'll give you real quick because I know we're kind of short on time. So I mentioned that here in the U.S., we've got this rule going into effect May 11th where, you have to verify beneficial owners with a 25% ownership or control. In Bermuda, for what's called a corporate service provider, that ownership or control could be as low as 10%, and you have to do that verification. They're also really specific on the number of officers, the type of officers and directors that you have to, go through the full-blown CIP. So I suppose in sum, what I'll say about, Caymans, Bermuda, or any foreign jurisdiction is, again, you have to start out by knowing what those laws apply to. Do not assume that they're going to be the same as U.S., and then look into the rules in detail to determine, what information is necessary, how do I have to verify it, because it could be spelled out versus just a reasonable base, reason to know, no, there it may be you need to do certain things, and there's, different record-keeping requirements, risk assessment, et cetera. So I know that's a very general comment. I can tell you that their rules are complex and they're hundreds of pages long when you look at the guidance notes and the regs, the laws, and that's probably as best I can do in just a couple minutes' time.
And, just for the good of the order, Bitcoin, we've been told, is actually very favored by the regulators because even though people say, oh, it's anonymous, it isn't really. The immutable blockchain ledger makes it easily traceable which computer was involved in the transaction by URL and other unique identifiers. Now, there are ways that people try to mask that, but from what we've told, at least anecdotally, the authorities are indicating that they actually like transactions that occur on the blockchain because they're very easy to track. I'd like to thank our panelists, Angel and Gil and Mark. Thank you again for participating on the program. Certainly, if any of you have any questions, feel free to contact me or any of the presenters. We'd be happy to speak with you about that. And please join us next month for the next edition of Investment Management Roundtable. Thank you all.